right now, there is a 1,200-foot commercial cargo ship just idling somewhere off the coast of Oman.
Yeah, burning thousands of dollars in marine fuel every single day.
Right, every day. And the captain is just staring at navigation charts, completely paralyzed, like too terrified to take his vessel into the Strait of Hormuz.
Which is completely unprecedented.
Right, and you don't know this captain's name. You will never see his face.
No.
But his decision to idle that ship in the water is currently dictating the interest rate on your mortgage.
Yeah.
It's dictating the valuation of your retirement portfolio and, well, precisely what the Federal Reserve is doing with the money supply in the United States.
It is the ultimate real-time demonstration of global economic interconnectedness. I mean, we tend to view the American economy as this, I don't know, self-contained sovereign machine, right?
Right. Operated by a handful of policymakers in Washington, D.C.
Yeah, but what we are witnessing right now is the complete hijacking of domestic monetary policy by a foreign geopolitical choke point.
Hijacking is a strong word, but yeah, it fits.
It really does. Trillions of dollars in domestic wealth are currently hanging on the navigational decisions of shipping conglomerates halfway across the globe.
So we are going to unpack the mechanics of this from top to bottom today, because this isn't a political debate about the Middle East conflict that kicked off back in February of 2026.
No, not at all.
We're here to run a forensic analysis on a highly sophisticated, multi-layered economic chain reaction.
Right.
You might be listening to this on a treadmill in Ohio or driving to work in Texas, assuming you are perfectly insulated from maritime shipping lanes in the Persian Gulf.
Sure, it feels far away.
But the data we are parsing through today proves that insulation is, well, it's a total illusion.
The primary transmission mechanism for this entire macroeconomic shockwave is, as you mentioned, that disruption in the Strait of Hormuz.
Right.
We are talking about a maritime strip of water that is arguably the most critical energy artery on the planet.
And when the Regis conflict escalated violently in February, the constraint on commercial shipping was instantaneous. It wasn't like a gradual slowdown.
No, immediate. Commercial vessels were immediately rerouted around the Cape of Good Hope. And that adds, well, it adds weeks to transit times.
Weeks. And what does that do to the insurance?
Oh, insurance premiums for tankers attempting to traverse the region didn't just increase. They multiplied to a level where the math of moving oil simply broke down.
And we don't even have to speculate on the domestic fallout of this. The Federal Reserve explicitly stated in their own recent board reports that this specific conflict severely damaged energy infrastructure, constrained shipping, and
forced oil prices to become highly volatile.
Yeah. But this brings us to the core paradox of our current economy, and really the whole reason we're doing this deep dive.
Right.
6 months ago, back in February, every institutional investor on Wall Street knew oil was going to spike.
It was the most crowded, obvious macro trade of the decade. War in the Middle East equals an energy shock.
Right. But the U.S. economy over the last 6 months has absolutely refused to behave the way the textbooks dictate an economy should behave during an energy shock.
The consensus 6 months ago was practically unanimous. A massive, sudden onset oil shock of this magnitude was supposed to immediately crush discretionary consumer spending.
It was supposed to send industrial production into a tailspin, spike unemployment.
Yeah, force a massive, painful economic reset. The logic is usually undeniable. Energy is the baseline cost of everything.
If it costs more to power a factory, move a good, cool a storefront, those costs eat the consumer alive.
But the dominoes simply haven't fallen that way.
I want to look closely at the actual data here, because right now we are looking at an economy of pure, unadulterated contradictions. Let's start with the energy shock itself.
The numbers are wild.
Staggering. March through April, we are looking at PCE energy prices, and we're tracking the underlying personal consumption expenditure data here, surging a massive 24% year-over-year through May.
A 24% spike is a systemic structural shock to the baseline cost of human activity.
Yeah, 24% is huge.
And what's crucial to understand is the velocity of that price action. We went from a relatively balanced, stable global energy market in January directly into a high-cost, hyper-volatile paradigm in a matter of weeks.
And that kind of velocity usually breaks financial models.
Yeah, because supply chains simply cannot adapt fast enough to absorb the margin compression.
But I'm looking at the broader macro data, and I have to push back on the traditional models here. If energy costs surged 24%, why did the entire U.S. economy immediately crater?
That's the big question.
Let's walk through the mechanics. If it costs 24% more to fill up a fleet of delivery trucks, The logistics company passes that cost to the retailer.
Yeah.
The retailer passes it to the consumer. The
Yeah.
consumer, whose wages haven't got up 24%, gets tapped out. They stop buying discretionary goods.
And then factories see orders drop, they halt production, initiate mass layoffs.
That is the classical cycle of an oil-induced recession.
Yes.
But look at the second quarter numbers. Real GDP still managed to grow at a 1.5% annualized rate. And consumer spending, and this is the metric that absolutely defies logic right now, actually grew by an incredible 3.9%.
The resilience of the American consumer is forcing economists to rewrite their models in real time.
I mean, it makes no sense.
Well, to understand why a 24% energy spike didn't trigger an immediate recession, we have to look at the structural buffers that exist in the modern economy today. Things that simply didn't exist during, say, the oil shocks of the 1970s.
Like what?
First, the U.S. economy is vastly more service-oriented and digitally native.
Okay.
While an energy spike hurts profit margins, it doesn't instantly paralyze a digital software company, a financial services firm, or a healthcare provider. Not the way it would a heavy manufacturing base.
Right, because they aren't firing up massive oil-burning furnaces just to write code.
Yeah, the energy intensity of the U.S. GDP has steadily declined over the last 40 years.
So we just require fewer barrels of oil to generate $1 of GDP than we used to. But that still doesn't explain the consumer side. A 3.9% growth in spending while the cost of gas and electricity is through the roof. That implies the consumer is acting as a massive willing shock absorber.
They are acting as a shock absorber, but the mechanism they are using to absorb that shock is debt.
Ah.
Consumers are exhibiting a remarkable, almost stubborn willingness to maintain their nominal lifestyle by altering their savings behavior and massively utilizing credit.
So it's credit cards.
We have to look closely at the credit card data and the non-revolving credit metrics. They aren't necessarily buying a higher physical volume of goods. They're spending significantly more nominal dollars just to buy the same amount of stuff.
And to bridge that gap between their income and these new inflated prices, they're just aggressively swiping the credit card.
Yeah.
So it's not a sign of economic health at all. It's a sign of deferred insolvency. They're looking at the price at the pump, swiping the card, and essentially saying, that's a problem for future me. But a 24% spike is a massive gap to bridge with Visa and MasterCard, especially when average credit card APRs are hovering above 20%.
And that introduces a critical lag effect into the macroeconomic data. An energy shock takes time to bleed the modern consumer dry because the consumer has unprecedented access to revolving credit facilities and shadow banking products like buy now, pay later.
Buy now, pay later for groceries.
Yeah. It creates a mirage of strength in the retail sales data.
Yeah.
The GDP looks positive, spending looks robust, but under the surface, the consumer balance sheet is rapidly deteriorating.
Which brings us to the next layer of this contradiction, the inflation and labor mismatch.
Right, let's look at July.
If we look at the latest July numbers, we see something that feels totally counterintuitive. The July Consumer Price Index came in at 3.4%, which is actually down a tick from 3.5% in June. And if we look at core CPI, it is sitting surprisingly low at 2.5%. Now, I have to admit, when I first saw that core CPI print of 2.5%, my immediate reaction was just skepticism.
Sure.
How on earth can core inflation be sitting at a comfortable 2.5% when the baseline energy input for the entire economy is up 24%? It feels like the data is purposefully obscuring reality.
I completely understand why advanced market participants look at that spread between headline energy and core CPI and feel like they're being gaslit by the Bureau of Labor Statistics.
It really feels like gaslighting.
But we have to look under the hood at the exact weighting and behavior of the subcomponents. We all know core strips out food and energy to isolate the underlying domestic trend.
Right.
But what's really driving that low 2.5% number is a violent deflationary trend in core goods, and that is masking the energy shock.
Okay, let's drill into that mechanism. Because intuitively, expensive oil should eventually make everything else expensive. Plastics require oil. Moving apparel requires oil. How is that transmission mechanism broken right now?
It comes down to supply chain normalization colliding with retailer panic.
Retailer panic?
Yeah, think about the last 3 years. We had massive bottlenecks that artificially inflated the price of non-energy goods. Used cars, apparel, consumer electronics, furniture.
Right, everyone remembers the crazy used car prices.
Today, those supply chains have fully healed, and in many cases, retailers overordered and are sitting on massive inventory gluts.
Oh, I see.
Because the consumer is feeling the pinch of that 24% energy spike, retailers are terrified of destroying demand entirely. So rather than passing 100% of the new transportation and energy costs onto the consumer, retailers and manufacturers are absorbing the hit to their own profit margins.
And they are actively slashing prices on core goods to clear out inventory.
Yeah.
Ah, I see. So if I'm looking at the data, the price of gasoline and electricity is exploding, but the price of a used truck, a television, and a winter coat are all dropping sharply.
Spot on.
And that severe deflation in the physical goods sector is acting as a mathematical counterbalance to the energy spike. That's what's keeping the aggregate core CPI number subdued at 2.5%.
It's a tug of war within the index.
Mm-hmm.
But there's a dark side to this data, and it's where the illusion of resilience starts to shatter.
The labor market.
Yeah. If we pivot from prices to the labor market,
Yeah.
we just saw July payrolls fall. The economy actually lost 23,000 jobs, even though the headline unemployment rate miraculously held steady at 4.1%.
A negative payroll print is not something you can easily gloss over.
No.
The economy literally shrank its workforce by 23,000 positions in a single month. I want to debate the significance of this because 1 month doesn't necessarily make a trend.
That's fair.
We have to consider seasonal adjustments, weather anomalies, or isolated sector weakness. But taking it at face value, a negative print is a glaring warning sign about the structural integrity of the labor market.
It is the first definitive crack in the foundation. We have been waiting for the lag effect of the energy shock and high interest rates to manifest, and a negative payroll print is the manifestation.
It's finally showing up.
Yeah. When retailers and manufacturers are forced to slash prices on core goods while simultaneously eating a 24% increase in energy costs, their margins compress violently.
And when margins compress, executives panic.
Always. And the fastest way to defend a profit margin in a corporate boardroom is to freeze hiring and initiate layoffs.
So let me paint the full picture of this bizarre reality. We have gross domestic product growing, we have nominal consumer spending booming, we have core inflation metrics behaving perfectly.
On the surface,
Yeah. But we have energy costs exploding, and now jobs are actively disappearing. This forces us to look at the institution responsible for managing these contradictions. The Federal Reserve is completely cornered by this data.
Cornered might be an understatement. The Federal Reserve is trapped in one of the most perilous macroeconomic dilemmas since the 1970s.
Let's map out the narrative shift over the last few months, because the consensus has whiplashed violently. If we rewind to April and May, institutional investors were terrified that the Fed wouldn't be able to cut rates.
Yeah, some were even pricing in the terrifying possibility of rate hikes.
Right, and the logic at the time made sense. If energy prices were going to reignite headline inflation, the Fed couldn't afford to loosen financial conditions.
Because if they cut rates, they stimulate demand, which would just pour gasoline on an already volatile inflationary fire.
So the bond market in April started front-running the possibility that Powell would have to hike again to crush demand.
The fear of a rate hike in April was a rational response to the velocity of the oil shock. But as the data rolled in through the summer, the narrative fundamentally fractured.
Because of the jobs data.
Yeah. By August, the Fed finds itself trapped between two fiercely opposing forces that require entirely different monetary policy responses. On one hand, you have headline inflation remaining stubbornly above their 2% target, currently sitting at 3.4%, largely due to the energy drag.
Right.
On the other hand, you have growth and employment visibly buckling, evidenced by the negative 23,000 payroll print.
It's like trying to drive a car where the brake pedal is hardwired to the steering wheel.
That's a good way to put it.
You can't fix one problem without drastically worsening the other. This is textbook stagflationary pressure.
Yep.
You have stagnant or even declining economic momentum coupled with sticky, elevated inflation.
Yeah.
If the Fed cuts rates to rescue the weakening labor market and stimulate hiring, they risk letting that 3.4% inflation run totally out of control, especially given the unpredictable nature of the Middle East conflict.
And if they take the opposite approach, if they raise rates to finally kill the 3.4% inflation and bring it down to their 2% target, they risk turning a 23,000 job loss into a 300,000 job loss.
Wow.
They'd be intentionally triggering a severe deep recession. They are bound by their dual mandate, price stability, and maximum employment. Right now, those two mandates are at absolute war with one another.
So what does this mean for you, the listener? We talk about these macroeconomic crosscurrents, but what is the actual bottom line for the cost of capital in the real economy?
Yeah, where the rubber meets the road.
If someone is listening to this and they need to refinance a commercial real estate property or secure a business loan or get a mortgage, what is the Fed actually going to do?
We have to look at the consensus among those who study the Fed's reaction function most closely. The latest Reuters economist survey is incredibly telling regarding this paralysis.
What are they saying?
The overwhelming majority of institutional economists surveyed now expect the Federal Reserve to keep short-term rates completely frozen at the current level of 3.5 to 3.75% all the way through the end of 2026.
Frozen for the entirety of the year. They aren't going to move a muscle.
They cannot move. Any adjustment to the federal funds rate right now requires choosing a victim.
Wow.
They either sacrifice price stability and force the consumer to endure higher prices, or they sacrifice the labor market and force the worker to endure unemployment. So their strategy is intentional paralysis.
They're just hoping it fixes itself.
They are holding the line and praying that the geopolitical situation in the Strait of Hormuz resolves itself before the U.S. economy breaks entirely.
But this introduces a massive anomaly into the financial system. If the market universally believes that the Federal Reserve is going to freeze short-term rates at 3.5 to 3.75% for the foreseeable future, why on earth are long-term rates exploding upward?
This is where the mechanics of the bond market are signaling a profound shift in global confidence. The yield curve is usually a very predictable, highly correlated mechanism.
Sure.
But right now, the long end of the curve is in open rebellion against the Fed's short-term rate expectations.
Let me lay out these numbers for everyone because they are striking. As of mid-August, the 10-year Treasury yield is sitting around 4.73%.
Yeah.
And Reuters just reported that the 30-year Treasury yield reached a staggering 5.31%. Let's contextualize this for a moment. A 30-year yield over 5% is a massive systemic drag on the long-term borrowing capacity of the entire economy.
It changes everything.
It dictates the floor for 30-year fixed mortgages, long-term corporate debt issuance, and municipal borrowing. So I need you to break down the mechanics of this disconnect. Why are long-term yields completely decoupling from short-term expectations?
To understand the 5.31% yield on the 30-year bond, we have to deconstruct the specific risk premiums that investors are currently demanding. The first, and perhaps most obvious factor, is sticky inflation expectations over the long haul.
Meaning that institutional buyers of sovereign debt simply don't believe the Fed has the capacity to ever return inflation to a baseline of 2%.
You got it. When you purchase a 30-year U.S. Treasury, your absolute greatest enemy is inflation. You are locking up capital for 3 decades.
Right.
If inflation averages 4% over the next 30 years and your bond only pays 3%, you are experiencing a negative real yield. You are mathematically guaranteeing a loss of purchasing power every single year.
And the conflict in the Strait of Hormuz has exposed a fatal vulnerability in our energy supply chain.
Exactly. Investors are looking at that fragility and demanding a much higher yield today to protect themselves against a future where energy-driven inflation shocks are a recurring structural reality rather than a rare anomaly.
Okay, so the inflation fear is the baseline. What's the second mechanical factor driving yields up?
Massive, unrelenting government borrowing and Treasury issuance.
The supply.
We have to look at the pure supply and demand dynamics of the sovereign debt market. The U.S. government is running historic, multi-trillion-dollar fiscal deficits during a period of supposed economic expansion.
Which is unusual.
Very. And to fund that deficit, the Treasury Department has to issue an unprecedented supply of new bonds into the open market.
It's basic market saturation. If a publicly traded company suddenly issues a massive secondary offering of stock, flooding the market with new shares, the price of the stock drops. In the bond market, when the price of the bond drops, the yield mathematically goes up. The Treasury is forcing the primary dealers and the open market to choke down so much debt that they have to offer increasingly higher interest rates just to entice enough buyers to clear the auction.
Precisely. The sheer volume of issuance is overwhelming the organic demand. Which brings us to the third, and perhaps most complex mechanism, driving long-term rates, the return of the term premium.
Now, I hear this phrase term premium thrown around on financial networks constantly, often without any real definition. How should we conceptualize the term premium in the context of a 5.31% yield?
Think of the term premium as writing a blind put option on U.S. monetary and fiscal policy for an entire generation.
Okay, unpack that.
If I ask to borrow capital from you overnight, the risk of an unforeseen catastrophic event occurring before tomorrow morning is incredibly low. You might just charge me the baseline overnight rate.
Sure, I trust you for one night.
But if I ask to borrow capital from you for 30 years, the spectrum of risk expands exponentially. Over 30 years, we could see multiple global conflicts, severe pandemics, sovereign defaults, or massive paradigm shifts in global reserve currencies.
The unknown unknowns.
Right. The extra compensation, the yield premium that an investor demands to take on the sheer, unquantifiable uncertainty of time is the term premium.
For the last decade, during the era of quantitative easing, the term premium was practically non-existent. Central banks were buying up all the long-term debt, artificially suppressing that risk premium.
Yeah, they crushed it.
But now, because the geopolitical world feels violently uncertain with the Middle East conflict, sticky inflation, and a paralyzed Fed, investors are jacking up the cost of that long-term insurance.
Right.
They are effectively saying, I will lend the U.S. government money for 30 years, but I require a massive premium because I have zero visibility into what the global economy looks like in 2056.
That is a perfect summation. And that term premium is compounding violently with broader fiscal concerns regarding the sheer mathematical trajectory of the national debt.
We're talking about the interest expense feedback loop.
Yes.
The market is looking at the U.S. debt load, calculating the cost of servicing that debt at these newly elevated 5% interest rates, and realizing it creates a vicious cycle.
It's basic math.
The more it costs the government to borrow, the higher the annual deficit becomes just to pay the interest. To cover that higher deficit, they have to issue even more debt, which saturates the market further, which pushes yields even higher.
It is a negative fiscal spiral, and it fundamentally alters how foreign entities view our debt. This leads to the final factor elevating long-term yields, a structural shift in foreign demand and institutional appetite.
Who is buying the debt now?
Historically, the U.S. Treasury market was supported by an insatiable bid from foreign central banks, nations like Japan and China. They recycled their trade surpluses into U.S. debt to stabilize their own currencies and earn a safe yield.
But the geopolitical realignments we are seeing now, accelerated by the conflict in the Middle East, are changing that calculus.
Yeah.
Countries are actively looking to diversify their foreign exchange reserves away from dollar-denominated assets. If the structural, price-insensitive foreign buyers begin to step back from the Treasury auctions, the U.S. has to rely on domestic buyers to absorb the supply.
And domestic buyers are fiercely price-sensitive. They demand a higher yield.
Right. When the structural bid disappears, price discovery returns with a vengeance.
Exactly.
But I have to challenge the overarching narrative here, though. When you lay out all of these mechanics in a row, the entrenched inflation expectations, the market saturation from deficit spending, the violent return of the term premium, the interest expense feedback loop, and foreign central banks stepping away.
Yeah.
Doesn't a 5.31% yield on a 30-year Treasury signal something much darker than a temporary recalibration? Doesn't this signal that institutional investors are quietly, systematically losing faith in the long-term fiscal stability of the United States?
It's a heavy thought.
This doesn't sound like a blip caused by a cargo ship rerouting around the Cape of Good Hope. It sounds like the catalyst that finally broke the illusion of U.S. fiscal invincibility.
It is undeniably a profound repricing of sovereign risk. I hesitate to use a word as emotive as panic because the Treasury markets are still highly liquid and functioning mechanically.
It's not crashing.
Right. But it is a structural loss of faith in the premise that U.S. debt is an entirely risk-free asset. Investors are demanding to be compensated for a reality where the U.S. government's fiscal trajectory is unsustainable.
So the ship was just the spark.
Yes. The geopolitical shock in the Strait of Hormuz wasn't the root cause of the debt crisis. It was merely the exogenous catalyst that forced the bond market to wake up and look at the underlying deteriorating fiscal math.
If the bond market is signaling a structural loss of faith through these 5.3% yields, the immediate victim on the global macroeconomic stage isn't just the Treasury Department, it is the currency itself.
The dollar.
Let's examine what this is doing to the U.S. dollar, because we are seeing a marked weakening of the dollar against a basket of foreign currencies.
The weakening dollar is the next critical link in this chain reaction. The fundamental driver here is the shifting expectation of interest rate differentials.
Okay, explain that.
Because the market now believes the Federal Reserve is trapped, and cannot aggressively hike rates to fight inflation, the yield advantage of holding U.S. dollars relative to other currencies begins to compress.
Right.
Capital is mercenary. It flows to wherever it can get the best risk-adjusted yield. As expectations of Fed tightening evaporate, capital begins to flow out of the dollar.
Let me stop and play devil's advocate for the listener. Why should a small business owner in Ohio or a software developer in Texas care about the relative strength of the U.S. dollar on the global foreign exchange market?
It feels disconnected from their daily life.
Right. If I am earning dollars, paying my mortgage in dollars, and buying groceries in dollars, why does it matter to my daily life what the dollar is yielding against the euro or the Japanese yen?
Because the strength of the dollar fundamentally dictates the purchasing power of your domestic wages through the mechanics of international trade. Let's trace the microeconomics of a specific supply chain to see how a weak dollar directly imports inflation right into that small business owner's lap.
Okay, walk us through the exact mechanism.
Let's say an auto manufacturer in Ohio relies on a specialized microchip produced in Taiwan, or a precision steel component manufactured in Germany.
Very common.
Right. Those foreign suppliers calculate their costs and profit margins in their local currency, the new Taiwan dollar or the euro. When the U.S. dollar weakens on the global exchange, it literally means your dollar buys fewer euros.
Okay.
So if the German manufacturer still needs to make 100 euros of profit on that steel component, the Ohio auto manufacturer now has to hand over significantly more U.S. dollars to meet that 100 euro price tag.
So the cost of importing anything instantly rises, entirely independent of the underlying cost of the good itself. It's a currency penalty. And that Ohio manufacturer isn't going to just absorb that margin compression. They are going to pass that higher cost directly on to you, the consumer, when they sell the finished car.
Right. This is the mechanism of imported inflation. And it creates a devastating secondary inflation loop for a Federal Reserve that is already trapped.
It just makes the trap tighter.
Yeah. If the Fed can't raise rates, the dollar weakens. The weak dollar makes imports more expensive. Those expensive imports drive domestic inflation back up. That rising inflation traps the Fed even further, ensuring they can't cut rates to save the labor market. It is a vicious, self-reinforcing cycle.
It doesn't just impact consumers buying imported goods, though. It massively alters the financial engineering of U.S. multinational corporations. Let's talk about the earnings translation effect.
For a massive U.S. multinational, say a major software company or consumer electronics giant, a weak dollar can actually act as an artificial tailwind for their earnings reports.
A tailwind?
If a U.S. company sells millions of software subscriptions in Europe, they are collecting euros. When it comes time to report their quarterly earnings to Wall Street, they have to translate those euros back into U.S. dollars.
Oh, I see.
If the dollar is weak, those euros convert into a higher number of dollars, artificially inflating their top-line revenue without them actually selling a single additional product.
Conversely, if you are a domestic company that relies heavily on manufacturing overseas and selling domestically, your margins get absolutely crushed by a weak dollar.
Yes.
Let's pivot to how this currency weakness impacts alternative bearer assets. Because whenever we talk about a weakening fiat currency, we have to talk about gold. We are seeing gold dynamics shift rapidly in this environment.
Gold is traditionally priced in U.S. dollars across the global commodities market. The mechanics are highly correlated. When the U.S. dollar weakens, an ounce of gold becomes mathematically cheaper for investors who hold other fiat currencies.
Which drives up demand.
Right. This drives up global demand from foreign central banks and institutional investors, which inevitably pushes the nominal price of gold higher. But beyond the pure currency math, gold is acting as a psychological hedge.
A hedge against the Fed.
And the Treasury. As the bond market loses faith in the fiscal trajectory of the U.S., and as the Fed remains paralyzed, investors are fleeing to gold as a non-sovereign, hard asset that cannot be diluted by deficit spending or frozen central bank policy.
Before we move on from the dollar, I want to touch on how our currency weakness affects emerging markets, because it's a fascinating paradox. We often assume that a struggling U.S. economy is terrible for the rest of the world, but a weak U.S. dollar actually acts as a massive pressure release valve for developing nations.
It is a critical dynamic to understand. Many emerging market countries, nations in Latin America, Southeast Asia, or parts of Africa, issue sovereign and corporate debt denominated in U.S. dollars to attract international investors. When the U.S. dollar is incredibly strong, it financially suffocates them. It requires more and more of their local, often weaker currency just to service the interest payments on that dollar-denominated debt. It forces them to drain their foreign exchange reserves and often leads to sovereign defaults.
So when the US dollar weakens because our Fed is trapped and our bond yields are messy, those emerging market countries suddenly find it much cheaper, in local currency terms, to pay off their dollar debt.
Yes.
Ironically, American macroeconomic dysfunction provides a financial lifeline to the developing world.
It does. It eases global financial conditions outside of the United States, even as conditions tighten domestically.
Okay, let's take a breath and survey the macroeconomic battlefield we've just mapped out.
There's a lot going on.
We have a highly volatile geopolitical crisis in a major shipping artery. We have crude oil acting erratically. We have a Federal Reserve that is completely paralyzed by stagflationary pressures. We have the first real signs of a labor market contraction with a negative 23,000 payroll print. We have a 30-year Treasury yield sitting at an astronomical 5.31%, signaling a structural loss of faith in U.S. debt.
All right.
And we have a weakening U.S. dollar threatening to ignite a secondary loop of import inflation. By every traditional metric, the U.S. economy is walking on a razor's edge over a very deep abyss.
That is the unvarnished macroeconomic reality of the current data.
Which brings us to the giant, glaring elephant in the room, the absolute defiance of Wall Street.
The stock market.
Despite every single catastrophic metric we just listed, the U.S. stock market is hovering near historically high levels. The S&P 500 seems completely detached from the reality of the bond market, the labor market, and global geopolitics.
It's frustrating for a lot of people to watch.
For the average listener, this is the part that makes the stock market feel like an engineered casino completely divorced from fundamental economic reality. How is it mathematically possible for equities to remain this elevated?
This specific disconnect is the source of endless, heated debate among macroeconomists right now. Wall Street's counterargument to all of this doom and gloom relies on one incredibly stubborn metric: corporate earnings.
Really?
Yes. Throughout this entire 6-month geopolitical disruption, energy shock, and yield spike, the aggregate corporate earnings of the largest U.S. companies have remained remarkably, almost unbelievably strong.
I am going to aggressively debate this disconnect with you because I have to question whether this equity market optimism is actually justified by underlying fundamentals or if Wall Street is just willfully ignoring the macro risks to squeeze the last drop of momentum out of the market.
Let's do it.
Let's look at the logic. How can corporate earnings be strong when their baseline input costs are skyrocketing? Energy is up 24%. The consumer is ostensibly getting squeezed and relying on credit cards. Where is the profit margin actually coming from?
It comes down to two massive structural advantages that mega-cap corporations have built over the last few years: ruthless pricing power and brilliant balance sheet engineering.
Let's tackle pricing power first.
Okay. In a highly consolidated economy, oligopolies don't have to absorb input cost shocks. If energy costs go up 24%, a company with dominant market share doesn't just eat that cost. They raise their retail prices by 25%.
They just pass it along.
They pass the entire burden to the consumer. And in many cases, they actually expand their gross profit margins in the process, using the media narrative of inflation as cover.
The greedflation dynamic. They put out a press release saying, due to unprecedented macroeconomic headwinds in the energy sector, we are forced to adjust our pricing structure. Meanwhile, their net income hits a record high.
Yeah, that happens a lot.
But I have to push back on the sustainability of this. Pricing power is not infinite. We are already seeing earnings reports from major discount retailers showing that the lower and middle income consumer is aggressively trading down to generic brands.
That's true.
They are skipping discretionary purchases. If the consumer is broke and payrolls are shrinking, that pricing power eventually hits a brick wall.
You are entirely correct that pricing power has an absolute limit, and we may be approaching it. But Wall Street isn't just looking at pricing power. They are looking at the financial engineering of the balance sheets.
Right.
And this is where the mechanics become truly fascinating and somewhat perverse. The mega-cap companies that disproportionately drive the major stock indices are essentially operating as highly profitable, unregulated banks right now.
Unregulated banks, break that down. How are tech giants and large industrials weaponizing the current interest rate environment?
Go back to 2020 and 2021, when the Federal Reserve dropped interest rates to zero. Every major corporation with an investment-grade credit rating issued billions and billions of dollars in long-term corporate bonds at rock-bottom interest rates.
Like 1.5 or 2%?
Yeah, maybe 2.5%. They locked in that cheap debt for 10, 20, or 30 years. Fast forward to today. The Federal Reserve has hiked short-term rates to over 5%. These massive corporations are sitting on hundreds of billions of dollars in cash reserves. They are taking that cash and parking it in short-term money market funds and Treasury bills, earning 5.25% in risk-free interest.
Oh, wow. The arbitrage there is staggering.
It's massive.
So they're collecting 5.25% interest on their massive cash piles today, while only paying out 2% interest on the debt they issued 3 years ago.
Right.
The high interest rate environment, which is supposed to crush corporate profitability, is actually generating billions of dollars in net interest income for them. They have built an impenetrable maturity wall.
Precisely. The 5.31% yield on a 30-year Treasury is a bloodbath for a small business trying to secure a floating rate loan today. It is devastating for a first-time homebuyer trying to get a mortgage.
Absolutely.
But it does not negatively impact a trillion-dollar tech conglomerate that locked in its capital structure years ago. The macroeconomic pain is entirely asymmetric. The high-rate environment is a net positive for the largest constituents of the S&P 500, which is why the index remains so resilient.
That perfectly explains the disconnect. Wall Street is looking at the fortress balance sheets and net interest income of the top 50 companies, while Main Street is feeling the bite of a 24% energy spike, shrinking payrolls, and a frozen housing market.
Yes.
The stock market isn't the economy. The stock market is a heavily weighted index of the 500 companies most insulated from the economy.
And what's fascinating is how long this divergence can mathematically last. The equity market is essentially betting that these mega-cap corporations can outrun the weakening labor market.
Right.
But historically, this is a dangerous game of chicken. If unemployment begins to rise significantly, and again, we just printed a negative payroll number, the broader economy will eventually drag those insulated giants down.
Because if 100,000 people lose their jobs, they cancel their software subscriptions. They stop upgrading their iPhones. They stop booking flights.
Exactly. At that point, the fortress balance sheet doesn't matter because top-line revenue evaporates. Wall Street is betting on a soft landing that the bond market says is impossible.
Which perfectly transitions us to the horizon. We are exactly 6 months into this geopolitical conflict and the resulting economic shockwave. Where does the global economy go for the next 6 months?
We have to map it out.
Based on the geopolitical triggers in the Strait of Hormuz, we are looking at 3 distinct, highly divergent macroeconomic scenarios. Let's walk through the mechanics of each one. Scenario A is the Goldilocks outcome. The conflict ends.
In Scenario A, through either intense diplomatic channels, regional exhaustion, or a brokered ceasefire, the conflict in the Middle East concludes.
Okay.
The immediate result is that the shipping lanes through the Strait of Hormuz reopen and maritime traffic normalizes. When the physical constraint on the energy supply is removed, the risk premium built into the oil futures market evaporates overnight.
So oil tanks.
We would see crude oil prices fall sharply and sustainably.
And if oil falls back to, say, $65 or $70 the barrel, that massive 24% PCE energy spike we discussed earlier rapidly reverses. The baseline input cost for the economy drops.
Which means the headline inflation pressure eases significantly. That deflationary impulse gives the Federal Reserve the political and economic cover they desperately need to finally unfreeze monetary policy.
Right.
With inflation visibly trending back toward 2%, the Fed can begin cutting short-term rates to rescue the weakening labor market.
And if the Fed begins an aggressive cutting cycle, the bond market responds immediately. The yield curve normalizes. And we could see those elevated long-term Treasury yields, that 5.31% monster, get pulled back down.
Mortgage rates drop, the cost of capital for small businesses eases, and the 23,000 job losses we saw in July turned back into solid monthly gains.
It's the elusive soft landing.
It is the absolute best-case scenario, where the exogenous shock is removed just in time to prevent structural economic damage. But we have to balance that optimism with Scenario B. The conflict continues. This is the status quo scenario.
The slow grind.
Yes. In Scenario B, the war doesn't escalate into a broader regional conflict, but it also doesn't end. It becomes a protracted war of attrition.
Which means shipping lanes stay blocked.
The shipping lanes remain highly constrained, requiring expensive reroutes and astronomical insurance premiums. Because the supply constraint remains, crude oil stays elevated, oscillating in that highly volatile $85 to $95 range.
And because energy remains expensive, inflation remains incredibly sticky. It doesn't necessarily spike to 9% like it did in 2022, but it refuses to drop below that 3 to 3.5% floor.
And the core goods deflation we talked about earlier eventually runs its course as retailers clear their inventory. That leaves the energy inflation totally exposed.
Which means the Federal Reserve stays hopelessly trapped. In scenario B, the Fed executes exactly what the Reuters survey predicted. They stay restrictive, anchored at 3.5 to 3.75% for the next year or longer.
They don't have the courage to hike and crash the economy, but they don't have the data to justify a cut.
So in this scenario, economic growth slowly, painfully grinds to a halt. The sheer weight of high borrowing costs continues to suffocate capital-intensive industries.
Commercial real estate buckles under refinancing costs, small business formation dies, and the consumer slowly but surely drains whatever remains of their excess savings and credit capacity.
It's an economy trying to run in deep mud.
It is a scenario characterized by prolonged stagflation. It is exhausting for the consumer and highly corrosive to long-term economic health. But as painful as the slow grind is, it pales in comparison to the tail risk of Scenario C, major escalation.
Scenario C is the black swan that keeps central bankers and national security advisors awake at night. Walk us through the mechanics of a full escalation.
If the conflict widens, drawing in broader regional powers or superpowers, we could see a total military-enforced closure of the Strait of Hormuz or catastrophic physical damage to major oil production and refining infrastructure.
So this is no longer a shipping delay.
No, this is the removal of millions of barrels of oil per day from the global market instantly.
The resulting energy shock would be violent. We're not talking about $90 oil anymore. We're talking well over $120, maybe $150 a barrel in a matter of days.
Easily. And a price spike of that magnitude triggers an immediate, devastating secondary inflation shock. It bleeds instantaneously into the cost of food production, transportation, and every physical good in the economy.
Which kills the consumer.
Because prices explode so violently, consumer discretionary spending drops to absolute zero. It creates massive immediate growth shock, a sudden stop recession.
And what does the Federal Reserve do in that scenario? They are already trapped by 3.4% inflation. If inflation suddenly spikes to 7 or 8% because of $150 oil, while the economy is simultaneously crashing, what is the policy response?
They are forced into an almost impossible policy corner, reminiscent of the worst policy errors of the 1970s.
Which is?
To defend the credibility of the U.S. dollar, prevent a sovereign debt crisis, and stop hyperinflation expectations from becoming permanently anchored in the psychology of the consumer, the Fed would likely be forced to hike rates aggressively into a rapidly contracting economy.
Hiking rates while people are losing their jobs in droves.
It would guarantee a severe, deep, and highly destructive recession. It is the absolute worst-case scenario for global financial stability.
Okay. As a listener who is trying to manage a portfolio, run a business, or just understand where the world is heading, I need actionable metrics.
Sure.
If I want to know which of these three scenarios is actually unfolding in real time over the next few months, what specific variables should I be monitoring on my dashboard?
You need to isolate the noise and watch three specific, highly correlated data points. First, obviously, is the spot price of Brent crude oil.
Don't listen to the news, watch the tape.
Do not listen to the political rhetoric. Watch the oil tape. It is the only true real-time gauge of geopolitical fear and supply constraints.
Yeah.
If Brent crude decisively breaks and holds above $95, we are inching towards Scenario C.
Okay, and the second variable.
Watch the monthly non-farm payroll report, specifically looking for consecutive trend confirmation.
So one bad month isn't enough.
One negative print of 23,000 jobs is a warning sign. But if next month prints negative 50,000 and the month after prints negative 80,000, that is structural contagion. It tells you definitively that the corporate margins have broken and the consumer is tapped out.
And the final variable.
Watch the 10-year and 30-year Treasury yields. If the 30-year yield continues to march upward, approaching 5.5% or 6%, despite the underlying economy weakening, it signals something systemic.
It's the panic indicator.
It tells you that the global bond market is entirely rejecting the Federal Reserve's control over the inflation narrative and is quietly panicking over the long-term solvency of the U.S. fiscal state.
We have covered an incredible amount of ground today. Let's pull all of these intricate, highly technical mechanics together to view the bigger picture.
Let's do it.
We have essentially traced a breathtakingly complex macroeconomic chain reaction. It starts with a localized regional conflict that disrupts a vital maritime shipping lane. That logistical bottleneck sparks deep volatility in the global price of crude oil. That energy shock feeds directly into the domestic U.S. supply chain, artificially inflating the baseline cost of living and distorting the underlying inflation data.
And that sticky, energy-driven inflation completely paralyzes the Federal Reserve, trapping them in a position where they cannot cut interest rates to rescue a labor market that is just beginning to hemorrhage jobs.
Right. And that policy paralysis at the Fed deeply spooks the sovereign bond market, sending long-term borrowing costs, like the 30-year Treasury yield spiking to 5.31%, as investors demand a massive term premium for the uncertainty.
Which weakens the dollar.
Yes, that repricing of long-term risk fundamentally alters foreign exchange dynamics, weakening the U.S. dollar, which in turn threatens a secondary loop of import inflation.
And through all of this,
The headline stock market hangs completely suspended in the balance, propped up solely by a handful of corporate oligopolies who secured dirt-cheap debt years ago and are aggressively passing their inflated costs onto an increasingly exhausted consumer.
when you lay the entire sequence out, end to end like that, it perfectly illustrates the core reality we constantly strive to uncover in macroeconomic analysis. Global economic events eventually and inevitably reach your wallet.
Always.
There is absolutely no such thing as an isolated geopolitical event in a financially integrated, hyper-connected world.
And honestly, going through this entire analysis leaves me with a final, highly provocative thought for everyone listening. We started this deep dive by talking about the illusion of control, the comforting, widely accepted idea that a chairman of the Federal Reserve sitting in a boardroom in Washington, D.C. can unilaterally dictate the trajectory of the American economy.
It's a comforting thought, but
But look at the mechanics of what we just unpacked. If a single regional shipping disruption operating over a timeline of just 6 months can completely paralyze the United States Central Bank, break the traditional yield curve, and drive 30-year sovereign borrowing costs over 5%, how incredibly fragile is the underlying system?
it raises profound questions about systemic vulnerability.
It does. It forces you to ask, how vulnerable is the U.S. economy's massive multi-trillion-dollar debt structure to multiple simultaneous global shocks? If one choke point can do this, what happens if 2 or 3 nodes in the global supply chain break at the same time?
Yeah, it's scary to think about.
It strongly suggests that true functional control over the American macroeconomic engine might no longer sit in Washington. It might actually sit with fragile maritime logistics, complex foreign supply chains, and the unpredictable decisions of foreign actors halfway across the world. I want you to think deeply about that vulnerability the next time you look at the interest rate on a mortgage application or the price ticking up at the gas pump.
Yeah.
We are all deeply structurally tethered to the Strait of Hormuz. We will leave you with that to ponder.
Until next time.